If you put $200 into Bitcoin every month since January 1st, 2017, you'd have roughly $46,000 today. That sounds incredible until you realize you actually invested $52,000 to get there. So, was it worth it? Or did you just lock yourself into a losing bet? Here's what the data actually shows about dollar cost averaging into crypto and why the answer might surprise you. The core idea behind dollar cost averaging is simple. You pick an amount, you invest it at regular intervals, you ignore the price. The theory is that over time, you smooth out your entry point. You buy fewer coins when prices are high, more when they're low. It removes the emotional roller coaster of trying to time the bottom. And honestly, that part works. Here's what most people don't realize though. Dollar cost averaging doesn't actually beat lump sum investing in a straight line market. A 2020 Vanguard study looked at 60 years of market data across multiple asset classes. Lump sum beat dollar cost averaging roughly 2/3 of the time. Here's why. Markets tend to go up. Any cash you hold waiting to invest is a drag on your returns. So if you're deciding between investing today versus spreading it out over 6 months, historically, investing today wins more often than not. But Bitcoin isn't the S&P 500. Bitcoin has seen crashes of 86%, 77%, and 53% within single years. Those kinds of moves change the math entirely. When an asset can drop that fast, dollar cost averaging stops being a drag and starts being a survival strategy. A 2023 study by ByteTree Analytics examined Bitcoin purchases over rolling 4-year periods going back to 2012. Dollar cost averaging won against lump sum investing in approximately 74% of those periods. That's a completely different story than what the Vanguard data shows for traditional assets. Let that sit for a second. Crypto's wild volatility is exactly what makes dollar cost averaging work better here than it does in traditional markets. All right, let's get into the three main approaches you can actually use. These escalate in commitment, but also in potential return. Point one, the simplest version is setting up automatic purchases on a centralized exchange like Coinbase, Kraken, or Binance. You link your bank account. You pick your coin. You pick your amount. You pick your schedule. Done. This is the version that requires zero decision making going forward. You decide once, and the system handles the rest. Now, here's the thing nobody talks about. Most people who do this will eventually check their app during a dip, see the red numbers, and panic sell. They think the system failed them. It didn't. The system worked exactly as designed. They just didn't understand what they signed up for. Dollar cost averaging is a commitment to being uncomfortable during downturns. That's the whole deal. A friend of mine started putting $300 into Ethereum every month starting in late 2021. Within 6 months, her portfolio was down 40%. She almost pulled out, but she stuck with it. By 2024, Ethereum had recovered, and she was up overall on her average cost. That wouldn't have happened if she'd pulled out during the dip. That patience is what dollar cost averaging requires from you. Point two, this is where things get more interesting. Instead of buying just one coin, you split your monthly investment across multiple assets. Maybe 60% into Bitcoin, 30% into Ethereum, and 10% into a smaller altcoin. The advantage here is that you get exposure to different market narratives without trying to guess which one will win. Bitcoin is your store of value bet. Ethereum is your utility and smart contract bet. The altcoin is your high risk, high reward play. This approach requires a little more attention, maybe quarterly rebalancing, but it builds in diversification that most people don't get when they're just throwing everything at one coin. But here's the real question nobody asks. Is your dollar cost averaging approach actually optimized for crypto cycles? Here's what I mean. Most people set up a monthly buy and forget about it. But Bitcoin's halving events happen roughly every 4 years. These events cut the new supply entering the market in half. Historically, these have been followed by significant price increases in the 12 to 18 months after. If you're just buying a fixed amount monthly, you're completely ignoring this cycle. You're still buying through the halving, but you're not necessarily adjusting your strategy based on where you are in the cycle. Some investors split their monthly budget differently. They put more in during bear market bottoms and less during parabolic tops. It's not perfect timing, but it's smarter than pure mechanical buying. If this is clicking for you, hit subscribe. I've got the most important part coming up next, and it's something most people completely miss. Okay, so the third approach is the one I think changes the game for serious crypto investors. It combines dollar cost averaging with something called value tier investing. Here's how it works. You still have your baseline monthly purchase, let's say $200, but you also set aside an additional amount specifically for opportunities. When Bitcoin drops 15% in a week, you deploy that extra cash. When the entire market is panicking and everyone on social media is calling for zero, you deploy that extra cash. The key is that this second tier only gets used when there's blood in the streets, not just random dips. This approach has a name in traditional finance. It's sometimes called putting dry powder to work. Legendary investors like Warren Buffett have used this exact strategy for decades. He keeps billions in cash waiting for moments when everyone else is terrified. When markets crash, he buys. He's not dollar cost averaging, he's timing, but he's using DCA principles to fund his dry powder. You can do the same thing in crypto. Your monthly purchases keep you invested consistently. Your opportunity fund keeps you ready for the moments when prices make no sense. The numbers bear this out. In 2020, when Bitcoin crashed from $64,000 down to under 17,000, anyone who had cash sitting on the sidelines was able to buy at generational lows. People who had set up their dollar cost averaging properly had been accumulating through the 2021 peak and into the early 2022 decline. When March 2023 hit, those same investors were already positioned. They didn't need to figure out what to do. They already knew. The system told them. That one shift alone could make the difference between dollar cost averaging being just okay and it being genuinely powerful. So, here's the honest assessment. Dollar cost averaging into crypto works. It works better than it does in traditional markets because crypto's volatility creates more of those buying at a discount moments. But it's not magic. You still need to understand what you're doing. You still need to resist the urge to panic when your portfolio is down 30%, and you need to be honest about your time horizon. If you're investing money you'll need in 6 months, dollar cost averaging won't save you. Crypto is a long game. The 4-year halving cycle is real. The volatility is a feature, not a bug, but only if you have the stomach to hold through it. The 3 approaches are simple. 1. Set up automatic buys and commit to not checking daily. 2. Diversify across multiple assets and rebalance quarterly. 3. Layer in an opportunity fund so you're ready when the market hands you a gift. Pick the one that matches your comfort level. Start small if you need to, but start. Because here's the thing about dollar cost averaging. The people who make money with it aren't special. They're just consistent. They keep buying through every crash, every pump, every bear market, and every bull run. That's the whole secret. There's nothing more to it than that. If you got value from this, share it with someone who's been on the fence about getting into crypto, and subscribe for the next one. I've got something coming that builds directly on this. You won't want to miss it.